costs are not moving up as much as the price of gold. So the margins are expanding. The stocks are cheap. They're under-owned. I think the setup is just perfect for gold stocks. But you just have to be patient. Banking system is a little bit fragile, so gold is going to be a beneficiary there. So I think those trends are going to continue. The real question is, when does the North American and European, but the Western investor, particularly the North American investor, turn from selling back to buying? That's the real question.
Since the Federal Reserve's December meeting, data has reinforced the central view among Fed officials that inflation will gradually, albeit slowly, move toward the 2% target, supported by a low unemployment rate, steady hiring, and ongoing economic growth. Gold, often seen as a hedge against geopolitical uncertainty and inflation, also tends to perform well in a low-interest rate environment, as it does not generate interest. Adrian Day of Adrian Day Asset Management recently shared his thoughts on gold and gold stocks. Despite what he describes as a perfect setup for gold equities, most Western investors remain hesitant to get involved. According to Day, this reluctance stems mainly from the prevailing sentiment in the U.S., where many believe the economy is strong, the stock market is thriving, inflation is under control, and the Trump administration will continue to bolster these conditions. Between 2022 and 2024, central banks collectively added over 2,700 tons of gold to their reserves, marking the fastest accumulation pace in modern history. This trend shows no signs of slowing as we move into 2025, providing strong support for gold prices even amidst potential headwinds from a more hawkish U.S. monetary policy. Meanwhile, holdings of gold-backed ETFs soared to record highs in 2024, driven by portfolio managers seeking greater diversification. Investment demand is expected to remain robust in 2025, fueled by the likelihood of additional interest rate cuts by the U.S. Federal Reserve and other central banks. Adrian Day remains bullish on gold, pointing out that the structural drivers of demand are unlikely to diminish shortly. He specifically highlights the situation in China, where record house foreclosures in December, concerns over the yuan, and a fragile banking system are leading Chinese investors to turn to gold as a safe haven. We're about to explore the video, but first subscribe and hit the bell icon to keep up with our newest uploads. Your feedback in the comments is always appreciated.
You know, it's a really interesting market. I think we're back, more or less, in terms of buying patterns. We're back more or less to where we were at the beginning of the year. The central banks are buying again. China, as we know, which has been the largest buyer, had been the largest buyer of gold for 2 years, but paused back in June. They're back in the market in November and December. So we're going to finish the year. We don't have the year-end numbers yet, but we're going to finish the year, if not at an all-time record high. It's going to be a strong... So the central banks have come in, have picked up buying. China has particularly come back into the market. And then North American investors have gone back into selling. So we talked about, I know how, the North American buyers were just beginning to come back in, but now that's reversed as well. And so if you look at, for example, the GLD, which is a physical ETF, GLD since US Thanksgiving, not your Thanksgiving, but American Thanksgiving at the end of November, there's only been 4 days of inflows. Every other day has been an outflow. You look at the GDX, which are the senior stocks, the GDXJ, which are the so-called junior stocks, they're both getting outflows again. And significant, steady outflows. So we're back to where we were at the beginning of the year. And, the central banks are buying, China's buying, wealthy Middle Eastern and Asian people are buying, but North American are still selling. And I think that's a reflection, to preempt your question, I think that's a reflection. We know why the central banks are buying, because, and this is a point I would make, I think gold is going to continue to go up. And certainly even in November, I was thinking of a shorter-term correction. I wasn't thinking, or what I said is it would have been healthy. But the reason central banks have been buying for the last 2 years haven't gone away with Mr. Trump. And if anything, with Trump threatening 100% tariffs on any country that dares move away from the dollar, that does not make South Africa and Brazil say, sorry, we didn't really mean it. It makes them want to step up their defenses against dollar weaponization. So, I think that source of buying is going to continue to be very strong. And the second largest source of buying is the Chinese retail and consumers. And they're buying because they're worried about the economy, they're worried about the yuan, they're worried about real estate, record number of house foreclosures in December in China. And they don't want to put their money in a bank because the banking system is a little bit fragile. So gold is going to be a beneficiary there. So I think those trends are going to continue. The real question is, when does the North American and European, but the Western investor, particularly the North American investor, turn from selling back to buying? That's the real question.
With the newly elected U.S. president issuing a wave of executive orders and escalating trade tensions with some of the world's largest economies, it's no surprise that investors are flocking to gold as a haven. The World Gold Council, WGC, regularly publishes monthly reports on gold ETF flows, offering valuable insights into investment trends within the gold sector. These reports cover markets that account for approximately 3/4 of the world's annual gold consumption. Adrian highlights that the People's Bank of China, PBOC, actively seeking to reduce its reliance on the US dollar, is unlikely to invest in gold stocks such as Newmont or junior exploration companies for its reserves. Likewise, Chinese consumers, ranked as the second largest gold buyers globally, and affluent families in the Middle East, prioritize physical gold as a means of safeguarding their wealth. According to Day, this accounts for approximately 90% of the factors driving gold's recent performance. Now let's redirect our attention to a video.
Well, first of all, let's say that the XAU, which is the US index, from the beginning of last year is up 19%. So let's not cry too much. It's up 19%. That's not so bad. Everyone's complaining because it's not up as much as they would like, and their stock isn't up, right? I think there's two reasons for it. We go back to why gold moved over the last 2 years, who was buying and why they were buying. Well, the People's Bank of China is not going to buy Newmont for their reserves, let alone are they going to buy Ajax Exploration. They're trying to move away from the dollar, and they're just not going to buy gold stocks for their reserves. The same goes for Chinese consumers, who are the number 2 source of buying. The same goes for the wealthy families in the Middle East. You want to protect your assets. Protection means physical gold. It does not mean Newmont or Ajax. And so the reason that gold has moved over the last 2 years, and the people buying and their reasons for buying, really explain 90% of the reason, in my view. And then we come to where we are right now. I am surprised that there's ongoing outflows. There's no question about that. I am very surprised that there are outflows in gold and gold stocks at the moment in North America. But the reason that we don't have massive inflows is perhaps a little easier to comprehend, and that is that the economy seems strong, and Trump's going to make it even better, and inflation is under control, and Trump's not going to do anything bad there, and the dollar's strong, and Trump's going to make the dollar even stronger, and the stock market's doing well, and Trump's going to make the stock market even stronger. Why do we need gold? And so the narrative is just not, at the moment, it's just not favorable to gold investing. That'll change, and I think it'll change when, well, we talked about that, when the stock market rolls over, and when it's obvious that the economy is slowing. At the beginning of a gold bull market, money, and we've talked about this before, but everybody knows at the beginning of a bull market, most of the new money flows to the big cap miners. And then later on, and the big cap royalty companies, and later on it flows to the intermediates, and then the juniors, and finally the exploration companies come in when, in the, I was going to use a baseball analogy, but I don't understand baseball. So in cricket terms, when your 8th batsman comes out to crease, the juniors start moving. There's no question at the moment, but if you look at both the seniors and the juniors, frankly, the better quality companies are definitely performing better, and the market is being very, very quick to punish companies that have problems whether it's Franco-Nevada and their Cobre Panama royalty, or Mali with Barrick. But the market is punishing those companies' stocks very quickly, but it's also rewarding very significantly companies that have good returns. So I think the junior or good exploration results or anything, so you look at a company like Origin, which has a royalty on silicon. The stock's done very well. You look at AMARC that had good results last week. The stock's jumped. So the market, people are paying attention, but I think it's obviously the same group of investors. So when they buy one thing because it's doing well, they're selling something else. The time when the broad junior sector, that is good companies with good people doing good work, but nothing dramatic happening, the time when those stocks move is several years away, I think. So yeah, we have to be a lot more selective.
Gold prices hit a 2-month high this week, driven by a weaker U.S. dollar and rising demand for safe haven assets amid uncertainty over President Trump's tariffs and policies. Structural demand from central banks, Chinese consumers, and wealthy Middle Eastern families continues to underpin gold's performance, reflecting a growing preference for physical gold to safeguard wealth against economic uncertainties and dollar-related risks. Do you believe tangible assets like gold are the best way to preserve wealth today? Join the conversation. Share your thoughts in the comments, give us a thumbs up if you found value in this video, and subscribe to stay engaged with our community.